Assalamualaikum warahmatullahi wabarakatuh. Hello, my name is Mico Prayoga from Manajemen Class 22A with NPM 224111026. I will explain a little about the capital structure analysis. Understanding capital structure. Capital structure is a combination of the word structure and capital. The term structure itself is defined as a more detailed arrangement of each part. Meanwhile, the word capital is a collection of basic money to run a business. Therefore, capital structure means arranging basic money for running a business from the different sources for the company long term. From the explanation above, we can conclude the capital structure is related to the combination of equity shares, preference share capital, debt securities, long-term loans, retained earnings, and other sources of long-term funds that have been successfully collected by the company. This is what makes companies carry out strict supervision regarding the future financial condition of their company. Apart from the explanation above, several experts have clearly defined capital structure. The following is the definition of capital structure according to expert. 1. According to Gerstenberg. Gerstenberg defines capital structure as a process of increasing a company's capitalization, which includes various sources and resources that can be controlled, such as loans, reserves, shares, and bonds. 2. According to John G. Hampton defines capital structure as a mixed process of the impact caused by debt and equity on the financing of company assets. 3. According to I.M. Pandey. Pandey is a leading financial expert who has succeeded in proving his performance. He also provides an understanding of capital structure. From him, capital structure is a mixture of long-term funding sources consisting of debt, preference shares, and equity, both surplus and surplus. Thus, we can see that capital structure is a balance and collaboration between own capital and foreign capital owned by a company. Own capital in question is a form of ownership, meanwhile foreign capital is short and long-term debt. Capital structure objective. The existence of a capital structure aims to collaborate sources of funds, both permanent and active, in the company operational activities. This is done so that the company achieves optimal value. More than that, capital structure can maintain the quality and reliability of a company in carrying out activities. Capital structure theory. To delve further into capital structure requires detailed and systematic knowledge. This is also called capital structure theory. Capital structure theory is the basis used to carry out a certain capital structure, so that the process is controlled and balanced according to existing scientific knowledge. Example of theories underlying capital structure. There are 5 theories underlying the implementation of capital structure. Some of these theories were put forward by well-known financial experts. Apart from that, these theories are very appropriate for us by companies. Here is the explanation. 1. Traditional approach theory. The theory focuses on optimal management and mapping. Therefore, capital structure is seen as having a strong influence on company value. This is what causes the capital structure to be changed and adjusted to obtain optimal result in a company. 2. Modigliani and Miller theory approach. As the name suggests, the theory was coined by Franco Modigliani and Martin Miller. Both of them have the same view when discussing capital uses. Modigliani and Miller's theory propose 3 important propositions, namely: capital structure is not relevant to company value. As a result, the value of identical companies will remain the same or persist, while having no influence on the finance adapted to finance asset. Meanwhile, the value of the company depends on the expected income in the future, starting from when there are no taxes. It is important to have tax information. This is because the odds of asset and resource of funds will increase when you know the tax coverage. Apart from that, tax information is also needed to determine the reduction in the company average weighted cost of capital. There are no bankruptcy costs in the capital structure. In other words, assets can be sold and market price and earning before interest are not influenced by company debt. Therefore, investors play an important role in becoming price taker. 3. Trade-off theory. Trade-off theory holds the view that to determine the optimal capital structure, several factors are needed, such as agency costs, taxes, and financial difficulties. However, in order for companies to survive, this theory also emphasizes paying attention to assumption about market efficiency, Therefore, business actors will think about cost difficulties and how to save taxes. 4. Pecking order theory. The pecking order theory has the point of view that the level of profit that a company can have is large. So this will result in the company having little debt. This is what then emerges several preferences in sequence based on the pecking order theory. Here is the explanation. Companies can cause internal income from profit from company operations. Investment estimates can be used to calculate a target payout ratio. A company will have greater cash flow than expense when it has a constant policy of fluctuation and investment opportunity. If there are external conditions, the company will issue the safest securities first. 5. Information asymmetry and signaling theory. This capital structure theory is the only theory which sets the members and parties in the company do not have the same information regarding the assurance of risks. There are too few expressed in this theory. Here's the explanation below. Myers and Majlouf state that there are differences in information acquisition between manager and outside parties, where managers have more complete information about the company than outside parties. Therefore, the main axis in the company is the manager. Signaling is a view that explains that capital development that occurs due to debt is a signal the manager convey to the market. This happens because managers try to ensure their company has good prospect. In other words, there is an increase the search and wide open opportunities for investors. Maybe that's all I can explain regarding the capital structure analysis. Thank you.